Hello, and welcome to OTC, the online trading course. In this lesson, we will learn the basic terminology of the stock market. As we said, the stock market is nothing more than an auction. Individual investors, just like you and me, are making decisions with their own money in a real-time auction, ultimately based on supply and demand. If, for instance, a stockholder wants to sell his shares of Facebook, and there are no buyers at $61.66, the price would have to continually drop down until someone else stepped in and placed to buy an order for that stock with their broker. If an investor thought Facebook was going to grow its profits faster than other companies, they would be willing to bid up the price of the stock without hesitation. As you can see, the stock is affected by supply and demand because there are only a static amount of shares in existence. On the contrary, if a large investor were to dump his or her shares back on the market, the supply could be temporarily very high and overwhelm the demand, which is sure to drive the stock price lower. Please remember, always keep a perspective on stocks and never forget what they represent. What happens if you think Facebook will generate far higher earnings per share of stock within 5 years? Then you buy 1,000 shares at $61 per share for a total investment of $61,000. And on exactly the next day, the Facebook stock falls to $30 per share. Should you get upset? No, you shouldn't. In a situation like this, you need to remind yourself that the stock market is just like an auction. If you still think that several years from now, the company will generate the earnings per share you calculated when you first bought the shares, then all you need to do is wait it out. And then the price of the shares will start to go back up. Then you could sell it and make a profit. The share price may and probably will move around wildly every day as millions of investors all around the world make decisions about how much they're willing to pay at any given time. But really, the ultimate value of your shares will come from the profit the company generates. So, if Facebook stock did do what you anticipated and reached, say, $8 in per share earnings within 5 years, and kept the same dividend policy, your shares would collect $4.55 in cash dividends each year. That means you'd be earning 15 to 17% in cash dividends on the stock you purchased. This is exactly why you see many successful investors totally unemotional about stock market crashes. On the other side, they view these events as an opportunity to buy more shares and enlarge their stake in companies they like that can generate lots of cash. That concludes this lesson. Thanks for watching. Be sure to check out our other videos.